Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is, of course, the 6th of June, and we have Brent crude oil trading a little bit up this morning, recovering a little bit, but fairly insignificant, up about 30 cents. Brent crude oil still trading below $75 a barrel at 74.88 in early Asian trade today. So why is that? Let's go to Jay Maru, Head of Market Intelligence and Analytics for the Middle East and North Africa for Vortexa. Jay, good morning. It seems this oil market just kind of wants to go downward.
Yeah, it's a funny market, isn't it, Sean? We saw oil prices really pick up in sharp response to when the OFAC sanctions were announced in Russia on Russian tankers on January the 10th. But since then, we've seen a climb down, and I think that's probably a expectation management, a realization that actually any rhetoric on tariffs, any rhetoric on trade disruptions, really, it's not good for the global economy overall. And it's not good for global energy demand. It creates inefficiency, and that really creates macroeconomic concerns. And the flat price, the crude oil flat price, is an indication of what's happening with the global economy. And yeah, bearish demand sentiments are probably feeding into the more recent downturn that we've seen on prices. I think it's very different what we see on a macro level with Brent futures versus what we see in some of the kind of key pricing differentials for the physical contracts, but I'm sure we'll talk on that later on today.
Dmitry Zabalin, founder of Pantheon Insights. Dmitry, is this oil market, energy markets in general, perhaps, but certainly the oil markets, underestimating the geopolitical risk associated with can only be described as incredibly radical plans announced by the president of the United States to essentially ethnically cleanse 2 million Palestinians from Gaza, and the oil market didn't even have a hiccup? Any other day of the week, any other year, any other century, there would be, this would be very disorientating. Your thoughts, is the oil market underestimating geopolitical risk here?
In this particular scenario, it's unclear because when you look at geopolitical risk in the Middle East, my big question is, are markets pricing in supply side risks? So typically anything to do with Iran, we've seen elevated risk there, right? So for instance, in a paper that I published, I was not calling, but I found that there's a higher likelier chance than not that Iran will likely undergo a regime change between now and 2029. That doesn't mean it's going to happen, but it's a higher likelihood than not. Markets have, to a degree, likely priced in these tail risks, but it likely is such a small risk that it's not being reflected in the price. As far as Trump's latest actions vis-a-vis Gaza, it's unclear what the effects will have on oil. Now, if Iran outright said we are going to respond to this militarily, then of course you may then see oil prices rise on supply chain fear risks. But because that supply risk isn't there, because Iran hasn't made that proclamation, then we're seeing very little pressure being exerted on oil prices. We did see some volatility, if memory serves, around when Syria got a new government, essentially, but we saw pretty limited volatility because it was unclear how much it would affect local supply. So regarding this particular situation, I think it's too narrow to have supply disruption fears on a regional level.
Well, then sort of take that to a more tangible place, shall we say, rather than Trumpian rhetoric, which one can really struggle to anchor into meaningful policy change. But what is real is the fact that we are in a fairly fragile ceasefire structure at the moment, and the language of the president of the United States could be interpreted as a green light for Israel to carry out those activities rather than America, in terms of continuation of its very aggressive policies in Gaza. How fragile or not, or what is your assessment of these ceasefires translating into permanent agreements in which one could kind of bet the house a little bit more on?
That's a good question. The short answer is I don't know, but generally a rule of thumb is that a ceasefire doesn't really work if two opposing sides have irreconcilable worldviews that are not compatible with the other. So that's why, for instance, when we saw a peace deal or a detente between Iran and Saudi Arabia, they're not really reconciling ethno-religious tension that is irreconcilable so much as they are taking a strategic detente for both sides. Regarding the fortitude of this ceasefire, The short answer is I don't know. I do anticipate that if there is a breakdown, then we are more likely than not to see oil prices tick a little bit higher because it's again tapping into that broader concern of a regional spillover. I mean, certainly from the US and Israeli side, there is a stronger and more compelling opportunity to hit Iran harder now. And I think markets have priced that in and that risk is elevated. But as far as the ceasefire goes, the answer is I don't know. But I think if it does break down, we are likely to see, pardon me, oil prices tick higher on those supply disruption fears regionally. And you may also see defense contracting stocks catch a bid, much like they did on October 7 and all subsequent escalations in that region.
Let's welcome Anne-Sophie Corbeau, Global Research Scholar at the Center on Global Energy Policy. Anne-Sophie, welcome. I wanted to get your thought. I mean, we're talking about oil here a bit, but I'd like to get into gas and get an understanding, because it seems like gas kind of is in some sort of parallel universe. It used to be that we would sort of nearly talk of these two things as, moving literally gas priced off of oil for so long. But your thoughts of where gas is at? We're seeing talk down that Europe could face some elevated gas prices, that there's some tightness coming into the market. Outlook for gas at this time and the sort of 2 weeks into Trump era 2.0.
Well, that's a very good question, because indeed the markets, the global markets are very tight. And the problem is that in Europe, especially for the European Union, we have lost as the 1st of January about 15 billion cubic meters of Russian pipeline gas. And the European Union
And that's
is
completely gone now. That's the Ukraine gas is gone.
Gone.
Right.
Absolutely. Absolutely. Unless, there is a peace agreement between Ukraine and Russia, which would include potentially a revival of some of these volumes. But we are not there yet. This is a possibility.
So we had the last connection of pipeline gas from Russia was through Ukraine. That has now been, that deal is expired.
It's not the last one.
It's not the last one. Okay.
It's not the last one. Europe is still importing about 15 billion cubic meters, but through Turkey, through a pipeline which is arriving to Turkey and then going up to countries like Hungary. And Europe is also receiving some Russian LNG, liquefied natural gas. So it's not completely gone. However, it's much lower than before. And the problem is also that the storage levels, while being, in some sort of 5-year average, which is actually a decent level, they are much lower than last year's. And the problem is that means that Europe will have to import a lot more gas, and in particular LNG, in order to refill the storage. And this is what is keeping gas prices high this year, because there is this mandate to refill storage to 90% by November the 1st. And therefore, we are seeing this very strange thing, which is that summer prices are actually higher than winter prices, which actually doesn't give any incentive at all to market players to refill the storage, because they're not going to make any money. And why is, the price so high is also because there is relatively little or not enough LNG coming to the market. We are seeing right now 2 big facilities starting in the US. There is one starting in Senegal, Mauritania. There is one which is going to arrive from Canada at some point this year, but they are going to come progressively. They're not going to go immediately to 100%. So this is not enough to basically meet the needs of Europe and also potentially of Asia. Hence the relatively elevated gas prices that are impacting both Europe and also Asia.
You mentioned there in your commentary, early opening comments, that obviously the pipeline that's still coming indirectly to Europe through Turkey, but that Europe is still importing LNG from Russia. Most significantly, Germany. Germany is important, and I think even record amounts of LNG, if my data memory is correct, in recent months. How likely do you think that this this language of Europe cutting off from Russia, but actually in reality still swallowing as much Russian gas as it can in whatever legal ways it can? That tells me that Europe, and Germany in particular, would be quite ready and willing and able to return to Russian gas once we get this Trump deal that apparently is going to be announced in the coming days, how to get to ceasefire with Russia. Your thoughts on Germany's appetite to go back to business as usual with Moscow?
So first of all, Germany is importing LNG, however, not Russian LNG, or at least not directly, because there is a German company which is importing Russian LNG, but through a French LNG import terminal. The reason why, this LNG is arriving to Europe is also because this is next door. I mean, if you're looking at a map and you are looking where the Yamal Peninsula is and where Europe is, this is like literally making sense from an economic perspective. And also Europe has not put an embargo on Russian LNG. They have put some restrictions, including on transshipment, but they have not put an embargo, also because the market is tight. And this is, the kind of reason why Europe is very careful. This has been talked about, this kind of embargo, let's ban Russian LNG for about 2 years. But people realize if we do that now, maybe we are going to worsen the situation, and gas prices are very, very high, and industrials are literally screaming that they are going to die. So this is the reality now. On Germany resuming imports of Russian pipeline gas, this is going to be a tough one because the main avenues for that are one, the Nord Stream pipeline, which has been sabotaged. There is only one string which would be operational, and this is Nord Stream 2, which has never been fully authorized. Then the second avenue would be to go through Poland, which is not the best friend of Russia, to put it in a very bad way. And the third avenue would be to have some gas going through Ukraine. That could be possible, but I am not sure that huge volumes would be allowed because also, the main two parties which are going to be Mr. Trump on one side, Mr. Putin on the other side, and they are not completely aligned on gas because Trump's interest is also aligned with the interest of US LNG exporters. And these are very
They're both gonna have their own fight over the European market, which will complicate their abilities to get there. It's interesting. I mean, it's a fascinating year ahead in that space. Jay Maru, meanwhile, back at the ranch of all things oil and OPEC and Saudi Arabia, even with this weakening, declining oil price, we're now giving up any gains so far this year. Saudi Arabia's OSPs were announced today, and they put up the highest in 2 years, over $2 on their premium Arab Light. Your thoughts on how to interpret Aramco's move in this elevated OSPs announced today?
Yeah, very, very, very interesting signals coming out from Aramco on the latest OSPs, and I think it fits interestingly with the parallel that Anne-Sophie was talking about on gas, but on oil. So on one hand, when it comes to oil, it's a very different approach. Obviously, Europe has said no to Russian oil flat out, whether it's crude oil, whether it's diesel, and that crude oil has been heading towards China and India almost completely unabated up until recently. And what's happened is since the January the 10th OFAC sanctions have come in, that's created a buzz in the market where there's been concerns over short-term supply disruption, short-term shipping constraints on India and China being able to procure its crude for the near term. And as a result of that, what we've heard is Chinese and Indian buyers have been seeking other suppliers to fill the gap, at least in the short term, while logistical constraints can be resolved. And among those are, of course, supplies in the Middle East. And that makes natural sense given how close, for example, the west coast of India is to the Middle East Gulf, and also given the quality of crude, medium and heavy sour crude that comes out largely from the Middle East that Chinese buyers especially want. So it's perfectly natural in such a scenario to see Saudi Aramco raise their OSPs to account for the fact that there is more spot demand that's being emerging from some of the two largest buyers of crude oil in the world, and basically to protect the fact that otherwise, if we look at what's happened with the flat price, that's fallen as well. What's very interesting here is actually with the OSPs, some detail that's been somewhat overlooked in other media, and this is the OSP to the US. Now, by no means is Saudi Arabia a massive exporter of of crude to the US, but there is some cargo that still goes to the US. And it's very meaningful that the price increases for Saudi Aramco's crude to the US is much, much lower than it is for customers in Asia and Europe. And what this suggests to me is that maybe Aramco is thinking that given the potential reignition of trade tariffs talks between Canada, US, and Mexico, there's an opportunity here for Aramco and maybe other Middle East buyers to supply more medium and heavy sour crude to the US refining system, which is in dire need of this kind of crude, which is completely opposite to the type of crude that the US is producing in itself domestically.
Dimitri, I wanted to get your thoughts on all things Iran. I mean, we're just listening to Anne-Sophie there and Jay's comments. Clearly, the Biden era, bent over backwards into sort of spaghetti twists to sort of perceive that sanctions were present, but yet nothing was present and oil flowed everywhere and tankers, dark fleets grew by like mushrooms and so forth, and generally an era of unenforcement. And but now we have Trump's on the list of announcements, and of course it's been a firestorm of Trump announcements in the last 2 weeks in his first days in office. But just yesterday or the last few days was the return of the maximum enforcement of sanctions on Iran, which over the Biden era enjoyed fairly no enforcement of the sanctions were there but unenforced. Your thoughts on again, the oil market didn't react to that very little. Again, we've had a downward draft in oil prices this week, even after that announcement. Your thoughts on the likelihood that it will be enforced in the same format as last time and the outlook for sanctions in general there under Trump?
Yeah, definitely. So there's a lot of points there. I mean, part of the reason why crude oil prices fell this week is because we saw a report from, I believe it was the IEA, that came out saying that the U.S. had a higher stockpile of crude oil than was expected, and that was signaling an anticipation potentially of weaker demand. Regarding sanctions, generally the rule of thumb is that if you impose sanctions on a country, if they don't change their behavior within 2 years, typically they will just adapt to the existing system. And we saw that happen with Cuba, we saw that happen with Iran. And generally, sanctions only work when it's I mean, there's a whole set of circumstances, but one of them is it has to be very targeted and it has to be very narrow in order for it to work. Regime change is very broad, so obviously that's not going to work, right? Like I said earlier, we didn't see that with Cuba either. We haven't really seen that with Venezuela either. So regarding sanctions, I think in terms of the maximum pressure campaign, what I could see potentially happening is Trump could enforce secondary sanctions. So rather than targeting Iran directly, he could target Chinese and Indian companies that are importing Iranian oil because Russia, for instance, has been diverting a lot of its oil to China and India. And it's not entirely by coincidence that China is capitalizing on this cheap oil at a discount from Iran, precisely because they don't really have much of a market to sell it to. And they even just signed more recently a 25-year agreement to, I think, invest $400 billion over that quarter-century period in exchange for a steep discount in crude oil prices. So what I could see happening is that it kind of accomplishes two things at once. One, it strangleholds the Iranian regime even further, specifically the IRGC that gets a lot of its funding from its petro and oil activities. And it also hurts China at the same time because the relationship between China and the US, in my view, is on a secular downtrend. You may see periods of detente, but that's not really signaling a fundamental change in the trajectory of that relationship, which is just going to become increasingly antagonistic. So in terms of the effects of Trump's maximum pressure campaign, I think because markets had already priced in that he was going to do that, it's not really surprising when he did it. Markets are forward-looking and they anticipate what policies could be when
But I
they
suppose the
actualize. So
question
in this
is,
case, Trump got elected.
should we believe it, right? That's the question, in the sense that everybody's question now about Trump's, we have 25% tariffs on Mexico and Canada didn't even get to the start line. They were done by Monday night before the start line was crossed. The idea of whatever happened with Colombia and so. But is this one that will happen versus those ones that were a bit more rhetoric than anything else?
I would say so because the relationship the U.S. has with Mexico and Canada is far different from Iran. Even though obviously the U.S. has problems with its northern and southern borders, neighbors, respectively, the relationship with Iran is just outright antagonistic. Like I said, that maximum pressure campaign would complement what I view as a likely U.S. Israeli strategy to potentially install regime change in Iran between now and 2029 because the circumstances are optimal for it. I'm not personally calling for it, but it just seems that the circumstances from an Israeli and U.S. side would make a compelling argument for them to do so, and a maximum pressure campaign would help with a lot of that.
Sophie, just picking up on those thoughts about the sanctions and the tariffs and so forth. Part of that has resulted in the tariffs. The Canada and the Mexican ones didn't make it to the start line, but the Chinese ones seem to be doing so, although smaller at 10%. But China has announced retaliation and particularly targeted American products and commodities. Your thoughts on what impact these could have on this sort of fragile period in which the outlook for the redevelopment or the further development of American LNG facilities, export facilities, which are in essence, after Biden announced or decreed that there would be a pause on issuing new licenses, Trump has restarted those licenses, but nonetheless, the investment environment with the tariffs and sanctions loitering, are they likely to impact how those projects move forward, the pace of them? Your thoughts of that intersection point of a tariff world with the arrival or the investment into new LNG facilities?
That's a very timely question because we have a piece coming out, I think, today on exactly that. So, first of all, the US and China are not so much dependent on each other in terms of LNG. This is roughly about 6% of Chinese LNG import, 5% of US LNG export. This much all Chinese LNG players could actually redirect the gas somewhere else. However, what is important is, even with this 15% tariff, US LNG is still cheaper than spot LNG. So the Chinese they have a measured answer in terms of tariffs. Last time they answered, it was 25%. We are not there yet. So they are not actually, arming US LNG to the point that this is becoming uncompetitive, and we are seeing exactly what happened in 2019-20, which is completely stop of US LNG exports to China. But to come back to your question about future investments, this is very important indeed, because a lot of long-term contracts have been signed between Chinese companies and US LNG companies. Some of these projects are actually moving forward, they are under construction, but there are a couple of projects which are still expected to take final investment decision. So this could be at risk, and also, the appetite of Chinese LNG players could be at risk, when they are considering whether to invest into, the US or maybe Qatar, which has a lot of unsold LNG, and there are also a lot of other LNG export terminals in the world, which are, very interested in getting some Chinese LNG buyers. So this is a potential risk for indeed further LNG expansion in the US.
Let's go to the survey question of this morning, which is tackling, this idea we've given up all the gains of the oil price this year so far. I know we started the year at low 70s, we went up above 80 for a few days, and then have come back again, and we're now mid 70s. So my question this morning is, what is Brent crude oil more likely to hit first? $70? The floor, which is more kind of where we started the year, or $80, which is where we reached during the sort of middle of the month and have since fallen back from. What is Brent crude oil more likely to hit first, $70 or $80? In that decision, that answer, Jay, there is, to a certain extent, the outlook of both, obviously, on the demand and supply side. But on the supply side, we have OPEC Plus, who have to consider all of these activities. The decision by Aramco to raise the OSPs quite aggressively would indicate quite a bullish outlook that they might be able to start to unravel their OPEC cuts. Your thoughts on where OPEC might look at the market going forward? Currently, their policy is to start unraveling their 2.2 million barrel a day cuts before the middle of the year.
Yeah, so the current policy is from the end of March onwards to unravel this, but as we've seen with OPEC, they take a very much wait and see approach with things. I wouldn't expect any major surprise in terms of extra supply coming through, even if it's obviously demanded by the likes of India and China. Naturally, OPEC have to protect their position as producers and as generators of revenue for the resources that they have. I don't see any kind of major shift in policy or tone to kind of unwind supply more quickly than they have right now. And another point to mention is just when it comes to who can really provide the cargoes quickly if a situation changes, then in my mind, obviously Saudi Arabia is there and the UAE is there to an extent as well. But there aren't really that many suppliers of extra crude on a very quick, prompt basis if the world needs it. And when I say if the world needs it, I mean namely China and India, and the crude that they're after is the medium and heavy sour crude that isn't available from the likes of the US. So I think definitely see a more moderated increase in supplies rather than any kind of sharp swings to kind of really drive down the price too quickly.
Jay, just to follow up on, you mentioned earlier the sort of Biden going out the door sanctions on the tanker universe. How is that unfolding now in the last week? The dark fleet had, by the end of last year, got up to something quite significant, like nearly 50% of the market. Where is that at? Is that retreating? Where do you think that goes?
Yeah, I mean, so this dark shadow, or however you want to call it, this fleet of tankers that has been associated with Russia and has been sanctioned is huge, right? Naturally, that has impeded the ability for Russia to export crude. But really remember that there's this mechanism called the price cap. And ultimately, if Russia want to continue making revenue from selling crude, either they need to bring new tankers into the trade and do it that way, or they need to basically sell their crude below the price cap and get non-sanctioned operators into the market to facilitate that. So those are the two main routes to get.
And is that happening? Are we seeing non-sanctioned?
So we haven't seen that yet in a major way, but it's still too soon to say. I mean, it was January the 10th, and we still see cargoes making their way towards China and India. So yeah, I think we'll have to wait and see how much that happens. One observation I want to make on Russia is actually one thing that hasn't been talked about so much is on the product side. So on diesel, what we have seen is many tankers starting to slow down and float actually. So really a struggle for Russia to find buyers of its diesel on tankers that have been associated with Russian trade because of fear of sanction. So really that's going to be another thing aside from the crude side that's going to hit Russia.
Dimitri, I just wanted to get your thoughts. I mean, you mentioned quite strongly there that the US-China relationship is in a downward cyclical epoch, maybe even a spiral with occasional moments of détente. With that is an emerging idea of, as it was during the Cold War with the Soviet Union, you have to choose sides, which is a big sort of narrative floating in this part of the world where we are living in the middle in between. We're part of the in-betweenies. And I'm wondering your thoughts on that. Is that going to emerge? If that is the wider narrative, as you said, that we China, US, that there will end up being a situation of having to choose sides?
I mean, I think to a certain extent, you're already seeing that there are some countries that are able to withstand that force of bifurcation. Indonesia, Brazil, and Singapore are all great examples of that. They have sufficient economic weight that they can't be pulled to either side. There certainly is a bifurcating nature to it. You're seeing that being reflected, particularly in supply chains. Like the Biden administration's Inflation Reduction Act has several what I call ABC, anything but China. I didn't coin the term. I wish I did. Provisions in there that say you're only eligible for these tax credits if the supply chains for these goods or these minerals that make these, EVs do not touch Chinese supply lanes. You're already seeing that, but what China is doing is essentially rerouting their supply chains through other countries like Vietnam and Mexico, which is why when you're seeing Trump threaten EV tariffs against Mexico, it might seem odd until you realize that companies like BYD and others are setting up facilities in Mexico to circumvent U.S. sanctions and tariffs to then export through the Mexico-Canada border, the Mexico-U.S. border. So in other words, to answer your question, yes, some countries will be subject to this bifurcation, but those are typically ones that don't have that much economic weight. But the ones I mentioned before, Indonesia, which in my view is going to be a third power in Asia, sans China and India, Brazil in particular, and Singapore are immune to that for the time being.
And Sophie, last word to you. I wanted to get your thought again in the the outlook for U.S. gas, U.S. LNG exports, which of course Europe, as we started our conversation, are increasingly dependent on. In some ways, it appears that they're putting aside one dependency on Russian gas and potentially vulnerable to taking on another dependency on America. And Sophie, I wanted to get your thoughts on what is the outlook for US to meet those opportunities that European, Trump has been shouting a lot about the trade deficit with Europe and they need to buy more of our oil and gas. And yet it does look like US oil production is certainly last year was flat and this year the outlook is flat again. And with that, of course, the associated gas that comes with the production of shale oil and has fed a lot of the boom for U.S. exports of gas. If the U.S. oil production is plateauing, maybe even declining, your thoughts on how that could impact the U.S.'s ability to meet this opportunity of a European dependent market?
So in any case, I mean, because the US is starting new LNG plants and Europe needs more LNG, it's very likely that Europe in 2025 it will import a lot more US LNG just because, we are seeing two factors on both sides. However, I think, the real question is at what price and what is going to be the domestic gas price in the United States. And you are referring to the oil, which is very important because, some of the gas is produced because, there is it's associated with oil. And in general, we have seen over, the past few months that the gas prices in the US are increasing. Of course, they are still at very, very low levels, at a quarter of a fifth of what we have in Europe, but it's increasing. And there is a possibility, given that demand is increasing for LNG exports and demand is very robust for the domestic gas market, that maybe the gas production is not going to increase fast enough. And maybe, especially if we have a very cold winter next year, so 25, 26, that we have some gas price spikes, pretty high. We shall see, but this is a potential risk that I would not totally dismiss in the current environment.
Yeah, it'd be interesting to see as this, as we saw before the US permitted the export of oil, the gap between Brent and WTI used to be much wider, and now WTI has climbed up to close that gap. Now, would we see that happen in gas as the US starts to export its massive availability of gas, but at the cost of raising domestic prices? I mean, your Trump and MAGA land mightn't like that. We'll have to wait and see. We have to wrap it up here. Really great to have all of your contributions. 70 is more likely to be hit first rather than 80, according to the polling in this room. That's interesting, and a bearish sentiment. And Sophie Corbeau, thank you so much for joining us. Dimitri Zabelin as well from the United States, and Jay Maru here in Dubai. Really appreciate all of your insights today. As we said at the beginning, Brent crude oil trading a little bit below $85 or $75 a barrel. Oil producers probably wish it was 85, but no, 75. I think a sweet spot for everybody, nonetheless, consumers and producers. Have a great day, everyone. All the best.
Thank you.